Let's look at the liquidation of a partnership. Sometimes a partnership decides to completely close the business. In this case, we must liquidate the business and distribute the remaining assets to the partners. To do this, we must completely remove everything on the balance sheet. In other words, when you look at the balance sheet, remember the balance sheet is equivalent to the accounting equation, assets equals liabilities plus owner's equity. When you look at that balance sheet, once it's fully liquidated, everything should be zero. A business that does not exist cannot have assets. And if there are no assets, then there can be no claims against those assets. So that means there can be no debt or there could be no equity, okay? So everything on the balance sheet must come to zero. The typical steps in the process of liquidating business include first the sale of non-cash assets. We need to get rid of all non-cash assets or all non-cash assets that we do not plan to distribute to the owners. Once we do that, you'll probably have a gain or loss on the sale of those assets. So then we need to take that and we need to divide that gain or loss between the individual partners that exist. And usually any gain or loss is divided based on the income ratio or whatever agreement that partnership has for division of income. Okay? Gains or losses are income statement accounts. That means they impact net income. Therefore, they get divided based on the income ratio or whatever agreement exists to divide income. Then the next thing we do is sort of check for a capital deficiency, meaning we make sure the partner's capital is not negative. If all the capitals are positive, you just move on. Well, if the partner's capital is actually negative, which means it's below zero, then that partner has to do one of two things. Either they have to pay the cash into the partnership to bring their capital up to zero, or on the flip side, the other partners in the firm may agree to take on that partner's negative capital or that deficiency. In that case, it would be split between the remaining partners. So one of two things can happen there. Either the partner with negative equity or negative capital or negative interest, however you want to look at that, the partner with negative interest in the company has to either pay in a cash investment to bring their capital to zero, or the other partners of the firm must take on that deficiency. So it gets divided between the other members of the firm. Okay, so one of two things has to happen there. There again, if it doesn't exist, you just sort of skip this step and you move on to step 4. Next step, once we have sold our assets, we've divided gains and losses, we've made sure all the capitals are positive, the next thing we'll do is pay off our liabilities. In other words, we simply pay off our debt. So anything the company owes, we go in and we pay off that debt. Keep in mind that partners are legally responsible for debt. Any general partner has unlimited liability, so they have to make sure that they can pay off their debts. Hence the reason we take care of that capital deficiency. Then number 5, we distribute the remaining cash. So whatever cash is left, we actually distribute that to each partner. And we do that based on the partner's capital balance. Now, make sure you do not use the income ratio here. We do not want to use the division of income to divide assets. Divisions of assets are different. Remember, the assets get divided on whatever the owner's claim is, as you will see here in a few moments. Okay, so make absolutely sure you do not use the income ratio when you're dividing assets. Income ratio is for division of income. Division of assets is a little bit different, so do not use that, okay? So let's look at an example of a partnership liquidation. The Parker and Moss Company, a partnership, decides to discontinue operations and liquidate the business on March 1st, 2014. The company's balance sheet shows cash of $50,000, accounts receivable of $75,000, equipment of $25,000, accounts payable of $40,000 and notes payable of $15,000, Parker capital of $45,000, and Moss capital of $50,000. Prepare a schedule of cash payments to determine the amount of cash each partner will receive. Now, a schedule of cash payments, also known as a schedule of liquidation, either way, it's fine. But the first thing we start with is our actual balance sheet. So let's look at the balance sheet. And we want to make sure that our balance sheet balances before we get started. That's crucial, right? So it tells us cash of 50, accounts receivable of 75, and equipment of 25. So that's our first step. We're going to look at those three items. So now let's add that up, because remember, we have to balance. So if you take the 50 plus the 75 plus the 25, you get 150,000. So assets equals liabilities plus equity. So our liabilities and equity have to equal 150,000. So then we have accounts payable. And how much do we have in accounts payable? We've got 40,000 in accounts payable. We've got 15,000 in notes payable. And then we look at our capital. We've got 45,000 in Parker capital, and we've got 50,000 in Moss capital. Now, gain or loss, we'll deal with that here in a moment. Nothing exists to start with, so we'll deal with that here in just a little bit. All right, so do we balance? Well, we've got 150 in assets, so let's see how much do we have in liabilities plus equity. So we take the 40 plus the 15 plus the 45 plus the 50, and lo and behold, we have 150 in liabilities and equity. So we are in balance, so we can proceed with our liquidation. So the first thing we do is we sell off our assets. So we're going to go in and see how much assets did we actually end up with here. Now, in this schedule, let's say we sold off our assets for, what could we say, 150,000. So let's add that in here. So let's see, all non-cash assets were sold for, 150 seems a bit high, doesn't it? Let's say they were sold for 90,000. I like that better. So let's say we sold our non-cash assets for 90,000 on our books. Okay. Well, what does that mean to us if we sold all of our non-cash assets for 90,000? Well, one, that means we're receiving 90,000 in cash. Does everybody agree? I mean, if you sell off your assets, you get 90,000. Well, what has to happen then? Well, it says non-cash assets, so in this company, our non-cash assets are accounts receivable and equipment. Well, if you sell all of your non-cash assets, what has to happen to those accounts? They have to go away, right? So that means our account receivable has to go to zero, and our equipment account, because we sold both of those need to go to zero. Well, we've got a little bit of an issue here. We've got 90,000 in cash, but we sold off 100,000 in assets. What does that mean? Well, when you sell assets for less than their value on your books, you take what we call a loss on realization. So we're taking a loss on the sale of these assets. So we're going to go over here. We're going to say, okay, we have a loss. And how much loss do we have here? We've got a loss of 10,000 on realization, loss on the sale of these assets, okay? We are still in balance at this point. So let's do a balance just to make sure that everything is okay. So that balance comes out to 140,000 in cash. And again, after each one, we want to balance here. Sorry, I'm coming back in. I had to pause for a minute there to do a class, so I'm coming back to finish this. So if my wording seems to jump, that's the reason. So we got a balance of 140,000 in cash. That's the 90 plus the 50. And then how much do we have in other assets? Well, we've gotten rid of all of our receivables and we've gotten rid of all of our equipment. So those are zeros. Now, beyond that, we had no change in our liabilities, and we had no change in our capital at this point, so 45 and 50 for Moss. Now, we did have a change in our gain-loss, so now we have that $10,000 loss. All right, step 2 says we divide any gains or losses based on the partnership's income ratio. So anytime we're dividing gains or losses, we always do that based off of their pre-existing income ratio or their pre-existing agreement there. All right, so what's happening in that case? Well, notice we have this 10,000 loss, and we need to allocate out that 10,000 loss. Well, who is going to get it? Well, it's going to get split between our capitals. It's either going to Parker Capital and or Moss Capital. Well, again, we have to do it based off our ratio. So let's look and see, what was our partnership ratio? Well, in this case, let's just create one. So the partnership, let's say they do income. So let's say they share income and losses at a ratio of, what would be a good ratio? Let's say 6:4. All right. So now that we have our ratio written in there, we know that our income and losses are shared at a ratio of 6:4, which means 6/10 to 4/10, or 60% to 40%. So when we take this, we take that 10,000 And again, this is a loss, and we times that by 60%, which gives us 6,000. So of that, Parker is going to get 6,000, and then 4/10 or 40% is going to Moss. So Moss is going to take 4,000 of that loss. All right, so that's how we divide the income. We divide it based on the ratio. So now let's look at our balance again. We've got 140,000 still in cash. We still have no other assets. We still have our liabilities at 40 and 15. Now let's talk about capital. Our capital for Parker has decreased from 45 down to 39. And then Moss has gone from 50 down to 46. And then our gain or loss now is at a balance of 0 because we've allocated it out. All right, then the next thing we do is we look at our capital and see if there's any deficiency. Is there a deficiency? Well, both capitals are positive, so there's no deficiency. So we can skip that step. There's nothing more to do with that. We can move to step 4, which is pay off our liabilities. So pay our debt, so to speak. Well, what happens when we pay debt? Well, we've got two pieces of debt. We have an accounts payable and a notes payable. So when we pay off debt, our debt goes away. And then that means our 40,000 in accounts payable would go away, and our notes payable 15,000 would go away, vanish, so to speak. Well, why is it going away? Because we paid cash. Well, what's going to happen to our cash? Well, our cash is also going to go down, and in this case, it's going to go down by 55,000. 40,000 in accounts payable, 15,000 in notes payable. All right, so that brings us to our next step. Let's get our balance. So we're going to take the 140 and subtract the 55. So that leaves us cash of 85,000. That leaves us no liabilities, right? Now let's look at what happened to capital. Well, our capital was unchanged. So Parker has 39,000 and Moss has 46,000. And lo and behold, if we take that 39,000 plus that 46,000, what do we come up with? Hopefully, you come up with 85,000. Because remember, our accounting equation must always be in balance. All right. So then the last thing, we have got it down to where the only asset we have left is cash. The only thing left is our equity. So the last thing to do is distribute our assets. So we're going to go in and distribute the assets to the owners. Well, the only asset left is cash. And when we distribute the asset, our cash is going away. We're physically writing out a check for this amount to each of our partners. Well, how much does each partner get? Well, when we're liquidating, when we get to the point where we're dividing assets, assets are always divided based on the capital balance of the partner. Remember, the word capital simply means the owner's claim against the assets. So if there's 85,000 in assets and Parker has a capital balance of 39,000, that means he has 39,000 in claims. So he is going to get 39,000. So we're going to reduce his capital by 39,000 and Moss's by 46,000. Now, at the end of the day, when we balance out, we should have nothing left in this company because liquidation means the company ceases to exist. There is no assets, and if there's no assets, there can be no claims on those assets. Now that we've looked at the liquidation schedule, now let's look at the journal entries that would be required. So next thing is post the journals for each of these events. Well, if you can do the schedule, you can actually do the journals. If we look at this, the first thing we did was we sold the assets. So just go across the schedule and see what happened when we sold the assets. Well, notice cash went up, accounts receivable went down, equipment went down, and we had a loss. Well, when we look at that, how does cash go up? Do we debit cash or do we credit cash? Well, cash is going up, so in order to show that, we would actually debit the cash. So we debit cash for the amount of 90,000 there. So that would be our first thing. Then, as we go across the screen, we see that accounts receivable went down and equipment went down. Well, both of those are assets. How do we take those assets down? Well, we're going to go in and credit each of those assets. So you're going to go and you will credit your accounts receivable. And you would credit your actual equipment account. All right, so each of those are going down. So let's go over here. Accounts receivable again was 75,000. Our equipment was $25,000. Now notice what happens here. Well, our two credits are greater than our debit, so we need to fix this. We need to go in and say, okay, wait a minute, we need an additional debit. So we're going to go in, I'm going to clear this out, and we will do an additional debit. Let me undo that. So let's fix this really quickly. We want to go in and we need to credit accounts receivable for that 75 so that we can put our debits together. And we're going to debit loss on realization. All right, and that's the $10,000 loss. So again, we just want to make sure that we get those debits and those credits together. Fix my formatting, 10,000. All right, so that would be our first entry. We would debit cash. Cash is going up. We need to debit our loss on realization. Then we would credit our equipment and our accounts receivable. Okay? So then let's look at the next thing that happened on March 1st during this liquidation. And again, we're doing a quick liquidation. This is one day. I understand that if we did liquidate, it would take longer than one day. We're just dating everything March 1st. So keep in mind, whenever these events happened is when we would actually date them. I'm just sticking with March 1st. We're really quick at liquidating. All right. So then the next thing we did on our liquidation is we actually handled our gain or loss, and we distributed that gain or loss to our individual partners. So what's happening here? Well, each of our capital accounts are being decreased. Our Parker capital is going down by 6 and our Moss capital is going down by 4. So we're actually reducing their capital by the amount of loss. Well, think about this. How do we reduce capital accounts? Well, to reduce the capital, we're actually going to go in and debit those accounts, okay? So we're going to go in and we're going to debit Parker's capital and we are going to credit Moss capital. And it's going to be for the respective amount. We've got 6,000 and 4,000. Okay, so that'd be the first thing, and then that leaves us with our debit. Our credit. Well, remember we put the loss on the books as a debit. We're taking that loss away and distributing it to our capital, so that means we need to credit the loss. So we're going to go in and credit our loss on realization. And again, that is for the 10,000. All right. Now let's look at the next one. Again, we said everything happened on March 1st. Very quick there. The next thing that happened is we actually paid off our debt. So let's review what happens when we do that. When we pay off debt using cash. So our cash is being reduced. How do we take cash down? Debit or credit? Well, we reduce cash by crediting cash account. So then we look at the other side and we've got our liabilities. Our liabilities are also going down. So what do we do with liabilities to get rid of them? Well, payable accounts, liability accounts are reduced with a debit. So we need to go in and debit. So we're going to debit our accounts payable. And we're going to debit our notes payable. Hey, I cannot type today. My apologies. And then those two are our debits, and we said we need to credit our cash because cash is going down. So let's look at this. We're going to go in and debit accounts payable for the balance of 40 and accounts receivable. We're going to go in and we're going to hit our notes payable for the balance of 15,000. And then that leaves us with our cash, and our cash went out at 55,000. Okay? So that removes the debt and pays it off from our records. So then next, March 1st, we went in and we distributed the remaining asset. Now this is where we actually allocate the cash out. We're removing the cash from the company and we're sending that out to our individual partners. So that means our cash is going down, and that's an 85,000 decrease, so that's going to be our credit. And then both of our capital accounts are zeroing out. So in order to remove capital there, again, we need to debit that account. So we're going to debit Parker Capital, and we're going to debit that for 39,000 to remove that from our books. And then we're going to debit the Moss Capital to get rid of it in the amount of 46,000. And then the last thing we need to do is write that final check out of our cash account for a total of 85,000. Okay, so that is what we would end up with for our journal entries. All right, that is a quick liquidation schedule. So we've liquidated our assets, we paid off our debts, we distributed gains and losses, and we distributed our assets. And then we had our final journal entries there. That's what all four of our entries would look like.